Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about investment news that should be making headlines, but for some reason is quietly being published in the background and ignored by the mainstream media. So much has changed in the past year. The dose of stock market reality has been predicted on this show for the better part of a year. The narrative is that the main investors in the stock market are a bunch of rich dudes, the top 10% of the population, who make up the top of the economic ladder in society. But we have major pension funds that represent the income source for millions of ordinary working people who depend on that investment income for their retirement. A group of retirees is asking the state teachers' retirement system of Ohio to reject a plan to pay $9.5 million in performance bonuses to its investment staff. In the face of the worst inflation in 40 years, there's nothing more tone-deaf and wrong than the pension fund paying nearly $10 million in bonuses as a reward for losing $3 billion in the pension fund last year. STRS is the state's second largest public pension system, and according to their financial disclosures, bonus pay is part of a comp package that helps the fund attract and retain talent. The performance bonuses are paid to about 100 employees who manage their investments. The bonuses are based on how the fund performs over 1-year and 5-year windows compared with certain benchmarks. And even though the fund lost money last year in a big way, somehow the measurement outperformed the benchmarks. That is to say, the fund only lost 3.61%, while its peers lost 5.5%. STRS, like many public pension funds, operates on a fiscal year that ends June 30th. Its total portfolio dropped from $98 billion in 2021 to $90 billion at the end of June of this year. That's a $7.5 billion loss over the last 2 years. The fund pays out about $7 billion in benefits each year and takes in $3 billion in contributions. So even if its investment return was zero, the fund would have dropped by $4 billion in value. Clearly, they have a problem not just with investment returns. They have an actuarial problem where they're not getting sufficient contributions to sustain the fund. So pension funds were among those investors hard hit by the carnage on Wall Street this year. CalPERS, which is the California pension fund, serves more than 2 million members in the retirement system in California, and it administers benefits for more than 1.5 million members and their families. The global markets played a role in the CalPERS' first loss since the financial crisis of 2009. They announced a minus 6.1% net return on investments for their 12-month period that ended June 30th. Assets stood at $440 billion at the end of the fiscal year. The CalPERS investments in global public stocks returned a minus 13.1% return. Fixed income investments were down 14.5%, and these investments make up roughly 79% of the CalPERS total fund. Their private market investments fared a lot better, with private equity and real estate assets returning a positive 21.3% and 24.1% respectively. Now, according to the CalPERS website, those collecting benefits can request a cost of living adjustment, but the pension fund limits cost of living adjustments to no more than 2.2%. Clearly, those who are collecting pensions are losing ground in a massive way. Now, they also have a special provision for making up on lost ground with respect to inflation. It's a special protection under the program, but even that only amounts to a whopping $84 payment. So what's interesting is that stocks and bonds fare the poorest in the CalPERS portfolio and real assets perform the best. The city of New York has 5 pension funds that cover New York City employees. According to a recent report in Bloomberg, the city's pension costs will rise by $6 billion over the next 3 years, as both high inflation and falling stock prices have hammered the pension funds. 5 of the city's funds lost 8.65% for the fiscal year which ended June 30th. The funds will require taxpayer contributions to the funds to make up the shortfall. They're going to need $861 million in 2024. They're going to need $2 billion in taxpayer contribution in 2025 and $3 billion in 2026. The funds assume that they're going to get an average 7% rate of return on an annual basis, and they have not achieved that. Remember, that 8.6% decline in value was to June 30th. We've seen a significant decline in both stock prices and bond prices since the end of June. The real picture is worse than the published figures. On top of that, nearly all of the city's union contracts are expiring next year, and that's going to bring additional demand for wage increases as those contracts get renegotiated. Remember, cities don't have the luxury of printing money. They can't borrow money for day-to-day operations, so they face the prospect of very real financial hardship, rising property taxes, and potentially default. Over the past 2 years, we've seen record numbers of people quit their jobs because they calculated they didn't need to work any longer in a job that they were getting tired of. This was the so-called Great Resignation. Some looked at the value of their self-directed accounts and decided that they could afford to retire. Well, I'm here to tell you that the headlines later this year and into next year will include a realization that many who retired in the past year will need to seek employment. Pension funds and cities are also going to come under extreme pressure to increase taxes and reduce expenses. As part of your due diligence in any city that you might invest in, you want to make sure that you model a significant increase in property taxes. Just remember, the city of Nashville last year implemented a 38% property tax increase during a period of growth and rising property values. Remember, property taxes are calculated based on a percentage of assessed value. So if property values fall, so too will the city revenues. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.